Hey everyone, welcome back to Corporate Decoder, the place where we untangle the mysteries of corporate filings. Today we're diving into the world of net lease real estate with New Mountain Net Lease Trust. Get ready for a story that has all the elements of great real estate: new beginnings, high debt, and the question of long-term value. New Mountain Net Lease Trust just filed its annual report, also known as a 10-K. This is their yearly checkup with the SEC, letting everyone know how they're doing and where they plan to go. So what is New Mountain Net Lease Trust? Simply put, they invest in buildings and then they lease those buildings out to companies using a net lease. This usually means the company renting the building pays for most of the costs, like property taxes, insurance, and maintenance. New Mountain wants to give investors current income appreciation in value and protection of their investment money. They use debt, also known as financial leverage, to buy more investments. The company aims for a leverage ratio between 55% and 75% of their real estate assets. Using debt can increase the number of investments and returns, but also increases the risk of bigger losses if things go south. They do have some flexibility with leverage and are not obligated to seek shareholders' approval. As of the end of last year, they operated as one business segment. This means they are focused on a single area and not dabbling in other ventures yet. One thing that's important to understand is they sell their shares at a price that's usually based on the previous month's net asset value or NAV. NAV is an estimate of what the company is worth, but might not be the actual price that their investments could be sold for on any particular day. Now, let's discuss the seed portfolio diversification of industrial buildings. They are spread out across containers and packaging, commodity and specialty chemicals, food products, healthcare, equipment, and more. The buildings are located in the Northeast, Midwest, and South regions. They focus on tenants and sectors such as warehouse and distribution, automotive services, and commodity chemicals. These sectors are generally seen as strong and reliable, but that doesn't mean they are immune to broader economic problems that might affect them negatively. One important note: they have a share repurchase program, which might be the only way to sell shares, but there are limitations. The company can choose to repurchase fewer shares than requested, or even none at all, and the total amount they repurchase each quarter is capped at 5% of their overall net asset value. Our board of trustees can also change or suspend the share repurchase plan. This could impact your ability to sell shares quickly, and it could be difficult to access your investment money. One more thing to keep in mind: there are limits on who can own shares and how you can transfer them. This, along with not being publicly traded, means these shares are considered to have limited liquidity or might be illiquid. Of course, cybersecurity threats are real, so they rely on the advisor to manage those risks. A breach of data could cause interruptions, put them at risk of increased costs, and even hurt their reputation. As a newly emerging growth company and not being listed on the exchange yet, they're not required to comply with all the strict reporting rules that fully fledged public companies have to follow, including certain requirements around internal controls, executive pay, and external auditing standards. This gives them more flexibility, but might also mean investors have less insight into the business. They're going to have their investments appraised every year, but the appraisals might be done at different times, which could cause their NV or net asset value to change a lot. It's worth knowing that monthly values might not reflect every single change in value. They are selling common shares, but there is no real public market. They may only be sold back to the company, which limits your options and might mean you get less money than you paid. Okay, let's take a look at some of those key financials before I give you my overall take. They had about $263 million in restricted cash, representing subscriptions received in advance. The total liabilities are close to the amount of restricted cash for now. The total equity is almost nothing. For the year ended December 31, 2024, the predecessor had rental revenue of $108 million. That is roughly a decrease of $2 million compared to the prior year. Interest expense was $42 million, which was a roughly $1 million increase from the prior year, showing borrowing costs were rising. The real estate investment total was about $1.3 billion, of which $139 million was in accumulated depreciation. Overall, New Mountain faces risks similar to other real estate investment trusts or REITs, like economic changes, tenant issues, and competition from other REITs. Also, as a shareholder, you will have limited voting rights to influence management and decisions. This might not be a business you can actively manage. New Mountain Net Lease Trust is embarking on an interesting path. They are seeking stable returns from a specific type of real estate in a complicated economic environment. There are some clear strengths given their access to capital at this time and the strong expertise of New Mountain Capital. I am also glad that they've taken a conservative approach and have not yet begun any large investments in the real estate sector. However, investors should be aware of the potential for rising interest rates to negatively impact their profitability, especially if revenue comes down and they are exposed to broader economic slowdown. The high management fees and the performance allocations to the special limited partner create incentives that might not line up with investor goals and should be taken into advisement before considering. Thanks for watching. If you want to see more deep dives into corporate filings, be sure to subscribe, like this video, and let me know your thoughts in the comments.